Past performance is not a guide to future performance. You'll see that statement or some variation of it written all over the place when you're looking at making an investment. And it's something that we'll tell you too. But at the same time, we put quite a lot of effort into communicating past performance to you. So why do we bother? Well, let's think about, is the statement true? In the short term, yes. Taken on its own, without any other information to provide some context to the numbers, past performance doesn't give you much of an indicator of future performance. But we would argue that performance data can be useful. We think there are good investment managers and bad investment managers, and managers who do better in certain scenarios, and funds whose performance is pretty predictable because of what they invest in. If you're thinking about, does this past performance is not a guide to future performance statement actually make sense or not, you kind of need to go back to the core argument whether it actually makes sense to active investment management at all. So active managers choose a selection of investments and invest proportion of the portfolio in each investment, thinking about how much money they might make and how much money they might lose, and the likelihood of these, thinking about risk versus reward. Passive managers just replicate an index or follow blindly a set of rules that determines what proportion of the stocks end up in the portfolio. For a long time, a lot of theoretical work about investing assumed that markets were perfect, which means that the prices of investments just reacted to the available news. Everybody had access to all the same news. Investors would act rationally and would all react to the news in the same way. And it wasn't possible to predict what the news was going to be. So therefore, active investors were wasting their time trying to predict what the stock might do. You might as well just buy a passive investment, especially because the fees charged on those sort of funds are much lower than those on active funds. But we know, because there's real-world evidence, that investment companies outperform unit trusts and that both outperform exchange-traded funds and index funds by quite some margin over long term, that can't be true. Think about investors behave in the real world. Investors aren't rational. They regularly get overexcited and overly depressed about investments. They don't all interpret news in the same way. And sometimes it is possible to second guess what might happen to demand for products and services. We think active investing works, but not every practitioner is good at it. Trying to sort the good managers from the bad managers requires some careful analysis, and performance numbers are one way of doing this. Short-term performance numbers aren't much use, however, because one lucky investment can distort returns. And think about it, they can also distort cumulative long-term returns. So to form a proper opinion, it might be better to look at longer-term data and individual one-year periods. In an investment company, if you're trying to work out how well a manager is doing, it's important you look at NAV returns, net asset value returns, and not the share price performance. The share price can shift around according to how popular the fund is as the discount and premium changes, but the NAV performance is a true measure of how the performance of the underlying portfolio is doing and how the manager is doing his job. It's easy to look at the track record of a fund and get excited about it, only to discover that the person or the team who generated the performance isn't around anymore, so it's advisable to check whether the manager hasn't changed. Take into account things like gearing. Because investment companies can gear their returns by altering their structure, not only through bank debt but also the issue of things like zero dividend preference shares, this can flatter performance in upper markets and vice versa. You must factor this in into your analysis.